Well, hello, Fearless, and welcome to another Tactical Tuesday. Can you believe it is March 2024 already? I hope the snow is melting wherever you're from here in Canada, and you're having a great start to 2024. We have a special guest tonight that is joining us for our Tactical Tuesday, and someone that's been on here a few times before, a familiar face. However, somebody that's also going to answer some questions for us. So tonight, guys, you have the opportunity to get any questions you have answered. And our guest tonight is our accountant, actually, a real estate investor focused accountant, and that's George Dube from BDO. So he's going to be joining us in a few minutes, and we're going to talk all things accounting. So bring your questions, guys. Tonight is going to be an awesome evening, and I'm really looking forward to it. Let's have some fun. Hey guys, it's Corey and Tiffany, and we're the co-founders of Investor Life.
And we help investors scale their portfolios using other people's money. Fearless, welcome to another Tactical Tuesday.
Welcome to another Tactical Tuesday. We have a really cool topic that we're going to be talking about tonight. This, guys, I hope is a scenario that shows you the power of leveraging your money.
We help investors take their portfolios from 2 or 3, 5 properties maybe, up to 15, 20, 50 properties if that's what they're wanting to
Really,
do.
the sky's the limit.
And we help investors scale their portfolio.
For our free weekly live trainings that we do over there on Facebook. Thanks for...
Hey guys, it's Corey from Investor Life, and Tiffany just stuck out her tongue at me. Okay.
Okay, that was a bad rendition. But guys, today, what wreck people in real estate? We're going to be talking about that, and we're going to make sure that it doesn't happen to you.
Welcome back, everybody, and we're happy to have you here. It's great to see the chat and to see everybody. For those of you that haven't done it yet, throw your name in the chat. Let us know where you're from. Great to have you here. Some of you, I'm sure, are here for the first time, and some of you show up every single week, and we really, really appreciate that. So get ready tonight, guys, let's talk about the accounting side of the real estate business. And there's certain things that affect us as real estate investors that might be slightly different than a typical person that's just filing taxes at the end of the year. What things do we need to know about? Especially maybe if we have a corporation, or maybe if we're buying them personally, or who knows what our situation might be like. I'm sure it's different for everybody. But we're going to ask our accountant tonight a few questions. And so that is why we're bringing on the experts for you guys, so that you have the opportunity to ask some questions. Hey guys, it's not costing you anything to ask questions to a professional tonight. And here's your opportunity. So without continuing on any further, I'm going to invite up George Dube. George, we've known you for quite some time now, and you've been our accountant for many, many years now, and welcome to our show.
Thank you. A privilege to be back again.
Awesome. And I saw Jules actually put a little post in our Ignited group tonight about the guy with the bow tie is coming on tonight. So you're famous across Canada for wearing the bow tie, and here you go tonight wearing it again. So thanks, George.
I didn't want to disappoint.
I love it. Okay, guys. So we got people from Ontario, Toronto, Manitoba, Mexico, Edmonton, Vancouver, Petersburg, Sherwood Park, Oshawa, all across the country. So welcome, everybody. Thanks for saying hi as you come on. And George, let's start at the very beginning. You were an accountant, but you're also a real estate investor.
Yes.
And why do you think it is helpful for somebody who is a real estate investor to have an accountant that is also a real estate investor?
I think it can go back to even when I started getting involved in real estate, and a variety of the teaching, for example, that's done at a college university level. It teaches something to the effect of, thou shalt not invest in real estate. It is bad, particularly if you use a corporation.
Okay.
And if there wasn't the practical knowledge that started, and don't get me wrong, I had that belief too, until I really started looking at it. And I think that's part of one of the keys is a lot of people are looking for what's the best answer today? What do the numbers look like today as compared to what will the numbers look like 3, 5, 10, 20 intergenerational years? And all of a sudden we get very, very different answers as to how things should be structured, what should be done. And so I think if we don't have that ability to talk to someone that goes beyond, if you will, the book smarts into as well being able to leverage off them for one of the most powerful questions I receive is not complex. It is simply, George, what would you do? And I think being able to draw on one of the reserves of not that I have a ginormous portfolio, but it's probably ginormous compared to somebody that's starting off, for example. And then being able to draw on the experience of seeing what a variety of our clients are doing, successes and failures. It's a lot less expensive to learn from those firsthand without actually going through that process, if you will. And so to me, being able to add some of that beyond the technical expertise is invaluable.
Absolutely. Very well put. And you touched on a couple of points. I got to grab my pen because as you're talking, I'm going to start taking notes. So you talked about, here's the first thing that comes to my mind, and it might not come to the minds of everybody, but the first thing that comes to my mind, okay, George, you're an accountant that's been doing this for a number of years. You have a team that works with you. You're at a big accounting firm, BDO, which is, nationwide, and I think worldwide in some, like it's a big international company, right? So, the first thing that comes to my mind is, oh my goodness, you must cost a lot more than, the accountant that I have at the strip mall in my nearby town. So would you say that, but then at the same time, maybe because of your experience and because of what you've done and the clients that you have and the fact that you've done this yourself, you could actually save me a lot more money on my taxes, etc. So can you just talk a second about how that, in my mind, if I'm just starting out, I'm thinking, I don't want to hire a big expensive accounting firm. Maybe I just want the little guy on the corner. But what would your answer to that be?
I agree. Certainly, a BDO being an international firm, we have more overhead than the person working out of the strip mall. Undeniable, period. I think the more important question is, what's the value added that can be brought to the table? And so if we're going to be more expensive, and for most folks, we will be, what's that difference? Why hire George and the team? The team is not perfect. George is not perfect. We try to get closer all the time, but we're not. And we see a variety of our colleagues at other firms. They are, to some degrees, by our professional body, being particularly the smaller firms, medium-sized firms, they're really being forced to offshore a lot of the work that they do. And I'm not saying that is, I used to be really, really against it. And it's not that I'm singing its praises, but the industry's kind of been forced by our professional body, in my opinion. I'm sure they would disagree to do that in terms of how we're bringing up that next generation of accountants. But as we have fewer and fewer going in through the education process and what have you, and making it more difficult for them to get their certification or firms to provide that, we're going down a different trail. So now all of a sudden, and I bring that up in the sense of BDO has a luxury of being able still to attract some of the top students, top graduates, etc. And it's not that my colleagues in smaller firms can't get good people. I mean, as certainly you're aware, Corey, it's not like Peter and I started at BDO by any means. I mean,
Mhm.
we had our small, medium-sized firm, and I think there's lots of wonderful things about that. But it would
Mhm.
be really challenging for Peter and I to attract the same level of talent that we can do at a BDO level, because we
Right.
don't want. And you mentioned the difference in fees, and absolutely. So we don't want George or Peter, for my partner Peter, working on a personal tax return or working. We want them taking the information of the personal tax return or the financial statements, corporate returns, etc. We want them evaluating what's going on, monitoring, and being able to sit down and do planning with you, effectively, whoever you happens to be, sharing some of those insights as compared to taking what might otherwise be, for many people, I'll call it a commodity, in the sense of, if somebody has 2 or 3 properties, again, I say, congratulations, that's better than the vast majority of people. That's wonderful. But Peter and I won't be able to add the same value to somebody that's looking to go from, even if they have 0 properties, but
Mhm.
looking to go to 5 properties, 10 properties, whatever their number happens to be.
Mhm.
Now we can add that value. If we're just really doing a tax return for someone with 1 or 2 properties, Peter and I would probably refer you to that smaller firm to say, we're not going to be able to provide that extra
Mhm.
input, if you will, to justify the difference in fees. But a lot of people are also surprised by what that difference in fees is. It's not necessarily um, as large as many people think. And in fact, in a variety of cases, particularly some of the smaller towns and whatnot, if it's more of a captive market, I've seen the pricing, and y- sometimes we're actually less expensive, which
Mhm.
can be a little bit surprising. But I would agree with the general concept that BDO is not looking for that investor with 1 or 2 small properties. We just can't bring we have tremendous resources in terms of skill sets, etc. And it costs us money to go and hire those people and whatnot, and those top graduates. And we want to be able to exercise that power to say, look what we can do for you. And we need a little bit of meat and potatoes to play with.
Yeah. Absolutely. It makes a ton of sense. So Jules asked a question here. At what point would you say then? So you say, the person with maybe 1 or 2 or 3 properties, maybe it doesn't make sense. At what point in your real estate investing business would you say that you would need to have somebody like you guys?
So somebody may not even have 1 property yet,
Okay.
but their intention, and they have some reasonable reasons to believe they can do this.
Hmm.
They do want to get the 5 properties, the 10 properties. And quite honestly, it's a lot easier for me to help someone when they have 0 and help them structure, because then we don't have to fix what's been already done. We can actually just move into a plan of taking away obstacles that otherwise are going to cost money. In most cases, maybe this also goes back to our prior discussion. Um, Given a reasonable period of time, and if people are following some of the planning advice that we have, we should be a profit center, not a cost center.
Hmm.
And again, I've encouraged people over the years to say, if you're actively engaged with us from a planning perspective, even if it's once a year, figuratively speaking, sitting down with me and chatting about your portfolio, if you've got a little bit of meat and potatoes there, I'm going to save far more than I'm going to cost. And I
Hmm.
just tell people, like, if I can't save somebody 3 times what I cost them, you should consider getting rid of me.
Right. Awesome. And well, hey, George, we haven't gotten rid of you yet. So you've obviously paid yourself off.
Exactly, and that's where I
Yeah,
think that big difference is not focused on the cost, but focused on what do we bring to the table to benefit the.
absolutely. Absolutely. And this whole theory kind of plays out in almost every industry, whether you're a realtor, whether you're a lawyer, whether you're, any of these professions that us as real estate investors use. Maybe the guy that costs a little bit more, but what's he bringing to the table versus the guy who's a little cheaper? And you kind of get what you pay for when it comes to a lot of these things. And so, I'm not saying that you guys are super expensive. In fact, I don't know that I even realized that the prices have gone up since we started when you guys were not with BDO. I don't know that it's changed a whole lot. So maybe it's gone up a little bit, but what you bring to the table is obviously offsetting that dramatically. So anyways, I don't want to pump your tires too much, George. That's not why we're here tonight.
Sure.
We're here to answer questions. But one of the questions Sharon has, and I know you have heard this one a million times, George. I've heard you answer it a million times, but when purchasing rental property, is it the first, second, third, etc.? When is it advisable to purchase in a corporate name versus a personal name?
Yeah, and this is going to piggyback on what we were just chatting about there, where I'm not as concerned whether you're at number 0, 1, 2, or 18. I'm much more concerned about where do you plan on being. And so we will have people set up corporations even before they've acquired their first property, assuming that they're starting to actively hunt down target properties. Because admittedly, some of these costs are exasperated in certain provinces compared to others. But if we have somebody in Ontario, for example, let's pick Toronto, where they've got, for those people, for example, in Alberta, you don't have the privilege of paying land transfer tax. Whereas if you're from Toronto, not only you get to pay land transfer tax, but you effectively pay twice the land transfer tax that others get to pay in Ontario. And so other provinces have and territories have their own regimes, and not everybody's got the land transfer tax. But all of a sudden, if you're paying, roughly speaking, 4% in terms of transfer taxes, and we bought, let's keep the number simple, $1 million property, and now we want to move it to a corporation, I mean, the lawyer and accounting fees for doing that transfer are cheap compared to the land transfer taxes. And so all of it, however, was completely non-value added in the sense of, how do we set up the corporation in the first place with the thought process we were going to need it? We could have avoided all of those costs. And so again, it doesn't take too many transactions for that more than made sense. Even if we're underutilizing that corporation for a couple of years while we put a few more properties into it, using my example, by the time you're done with legal and accounting, let's say it was 50 grand to move that property. My financial statements are nowhere near that cost. So just saving that 50 grand probably is going to pay for my financial statements, particularly if you can invest some of the money. I mean, for years and years and years and years. It's the math is a no-brainer.
Yeah. Okay. Cindy asks, what is the benefit of incorporating? Why would somebody get a corporation?
There's actually multiple benefits, and I like to classify them in different categories. The other thing too, I think, with that is to keep in mind, different investors will have or place different levels of importance on the different factors. So I kind of start off with what I call flexibility. And flexibility means if I buy a property personally in my name, it is what it is, in the sense of, now once a year, I'm going to add up all the rental income, take off the expenses. I get popped onto my tax return. It's really, really straightforward. I didn't have, if I had, in contrast to a corporation, the ability to decide what year would I like to pay tax on that personally. How would I like to pay tax, in the sense of, do I want a dividend? Do I want a bonus, a wage? Do I want a temporary loan? Do I want something else? If I've got family members, do I have other family members that own a portion of that corporation? Who am I going to pay amongst the family members? In terms of adding or subtracting shareholders, much easier to do as compared to if I own that property personally. So flexibility is one. Two is legal matters. And again, I'm not a lawyer, but it doesn't take much of a rocket scientist to do a little research and know that many lawyers prefer to have a corporation for a property for liability reasons. Whether that's what your lawyer is going to advise, I mean, that's between you and the lawyer, effectively. The third part is taxes. And so in many cases, contrary to popular belief, the corporation can be much cheaper from a tax perspective. I mentioned earlier, in terms of people focusing on what the taxes are today. And so often people get focused on the idea that, again, depending on the province or territory we're referring to, if we have long-term rental income, typically that initial tax rate for the corporation, the key word there being initial, is about 50%, 50. And if I compare that with personal tax brackets, well, it's going to depend on how much income that individual or the family has. And so a lot of the real estate investors are really going to be kind of between, say, 30 and a touch over 50% in terms of a personal tax bracket. So somebody that's getting closer and closer to 50 on that the personal side, they're really not going to notice much of a difference one way or the other. Some of the provinces, that personal rate is higher than the corporate rate. So the corporation provides more of incentive there, but they have to be at a pretty good tax bracket. The thing that most people are forgetting is that that corporate bracket is 50% initially. But if I pay out a dividend to a qualified shareholder, I get a 30% refund. So now my corporate tax rate's 20%. Now I have to see what's the taxes on the personal side. And again, as a quick example, if I pay a dividend of roughly $40,000, I'm paying about $1,000 in taxes, depending on which province or territory we're talking about. And where I kind of get towards the $100,000, I'm about 15 grand or so in taxes. So all of that's to say, let's stop focusing on what that day one tax rate is and focus on what the tax rate's going to be over the years. And even if I have to front end that 50% corporate tax, I'm accumulating the 30% year over year. I'm keeping track of it. Maybe for 10 years, I keep paying into it. But then I start getting it refunded because I've retired, I've semi-retired. My spouse says, maybe I've got adult children I can get dividends to. And now I've got this huge amount of reserve that can come out. Or I say, hey, Corey, Tiffany, I've got these properties in a corporation. Why not, instead of you buying the real estate, you buy my corporation? By the way, there's $2 million of refundable taxes there. Why don't we split that? So sooner or later, if it's in the corporation, I am going to somehow get some of that back, or my family will. If I'm paying 40, 50% tax personally, that money is gone forever. I'm never going to see it again. So again, so I'm not saying the corporation is always better. And if I'm flipping properties, I'm doing rent to owns, there's some other techniques a little bit more elaborate. I can get that tax rate down to around 25%, in some cases 12ish, 10%. So again, there's more opportunities there. Third thing we kind of look at, going back to the reasons to incorporate, is the financing. And certainly some individuals are going to find it more difficult to get funding through the corporation. We find if we're talking to people that know what they're doing on the funding side, they're usually going to find it much easier to get the funding. But I don't deny you can go to any major financial institution and find people there that absolutely positively have no idea how to get the funding. And you can go to that same institution and talk to somebody else, and they have no idea how you couldn't get it as long as you did it the right way. The last thing we look at is, in terms of that corporation, I'll call it the organization and the professional aspect. So if we're dealing with other investors, if we're dealing with professionals, tradespeople, etc., do you want that image of the corporation, or do you want the image of working out of the back of the pickup to do the work, if you will? Now, all of those 5 areas that we talk about, they could point to one direction or the other, and different people or different families may have identical fact situations, but we come to different conclusions because they place more importance on legal, for example, compared to something else. And I'm not trying to say somebody's right or wrong. It's just to say we need to evaluate that and figure out what's right for that particular family.
Yeah. So it is different depending on who you're talking to, right? And that's why having a chat with an accountant, sitting down with George or someone on George's team, now all of a sudden you can plan for the future. You can have a strategy. I'm going to do this. I'm going to do that. I'm going to make a corporation or I'm not, et cetera, et cetera. So Awesome. Let's see here. Great questions. By the way, guys, if you are listening right now and you have a question for that is real estate related or something that you've been wondering about, whether it's about incorporating, not incorporating, et cetera, now's your chance to ask the question. We have George here with us. George, if I wanted to open a corporation, do I go to my accountant or do I go to my lawyer or do I go to my registry office? Or like if I want to open a corporation, who do I go to get that done?
Most of the lawyers that we work with, they'll ask someone to go and chat with us first because they want us to make suggestions in terms of how is it going to be owned from a tax perspective, et cetera,
Mhm.
how we want it crafted. And then the lawyer is going to do the actual incorporation and make sure that from a legal perspective, everything we want from the tax side is still going to meet the lawyer's needs. So
Mhm.
it is a tag team. Most of the lawyers, as I said, will ask us to start the process because they really need to finish the process.
Okay, absolutely. Good answer. Okay, we have a question here from James and another one from Sean, and this has to do with this Bear Trust thing that's going on, George. We knew that we had to touch on this at some point, and I know Mike on your team reached out to me and sent us an email and said, "Hey guys, you probably need to take this into consideration." So this whole Bear Trust thing that's happening, can you first of all, Mark or George, first start out with what is a Bear Trust, and why us as real estate investors have to know this?
Yeah, so a Bear Trust, I'm going to loosely define
Okay.
as a scenario where the legal ownership of the property is different than the beneficial ownership of the property. Beneficial ownership meaning who has the rights and rewards of ownership, who gets the profits or sucks back the losses, if you will.
Okay.
And so commonly this is going to be the case where there's a joint venture in that often not all of the parties are on legal title with that joint venture, or it may be quite a number of real estate investors will acquire personally based on the advice of somebody at a financial institution, for example, and have beneficial ownership in the corporation because they want all the tax benefits to the company itself. And so again, it's a bare trust that exists. There's also even in a because it affects real estate investors, I'll just pop this out here too. One of the scenarios that scares the heck out of me, beyond although this does as well, um, is we won't know in many cases if, for example, our client has added their name to the bank account or investment account of their parents. And so they're trying to do for whether it's probate reason or practical taking care of the parents or children, minor children, same scenarios, just happens to spring out more so with elderly parents. And all of a sudden, again, legal ownership has perhaps a son or daughter, and then one or more of the parents. And but all if they've got like a traditional liquid portfolio, some stocks, some mutual funds, whatever, well, that income is going to go to mom and dad. But the next generation is trying to help them, and depending physical and mental capacity of the parents to various degrees. But forgetting all the reasons why, it's still a bare trust. And so then the practical reason to why do we care or why should we care? It's to say that Revenue Canada has put into there, well, they kind of traditionally use the carrot and stick approach, of course. Well, the carrot's like this and the stick is like this, where the stick is they have the ability to charge us if we fail to file a disclosing tax return, which is due March 31st. March 31st falls on the weekend, so it'll be the Monday, but you get the picture. But they can charge us 5% of the value of the property or assets in that trust as a penalty.
Hmm.
And odds are they're not going to audit it the first year. They're going to wait for 3 years, as a traditional example. audit us for 3 years, so we got 5% for 3 years, i.e. 15%. It's financially crippling. We like to think that Revenue Canada will be more lenient, and they've certainly announced that they do not intend on prosecuting cases to the full degree they could where there's been an inadvertent mistake or missed filing. My concern is my definition of inadvertent is probably very, very, very different than the auditor's definition. And of course, it's not defined how to do that. It's an administrative concession that has no basis in law. And so all of a sudden, we're at the mercy of Revenue Canada. So someone who chooses not to file, I mean, so be it. We're all big boys and girls, but that's a potential crippling impact to our portfolio, trying to raise 5, let alone 15%
of the value of a property.
Exactly, and those fees would be non-deductible, making it even more expensive. So it is quite a stick that Revenue Canada has. There's certainly been a lot of talk, including my own team, and I myself am fantasizing about them sort of doing what they've done with the UHT, in the sense of backing off and finding out there's a lot of paperwork that all of a sudden hit them. And I think they realized that the vast majority of it was completely useless, waste of time. I think that's what's going to happen with these disclosures as well. But unfortunately, I don't have the ability to change the rules. We're just trying to follow what we can. And it's so easy for Revenue Canada to check these things, particularly if they use a model of really looking at instead of a blanket audit, checking out in the years of dispositions how things were reported, and then fishing backwards, because then it's really easy for them to do. And so to what degree they do, or how they're going to move along in that, we've certainly noticed how they've handled the UHT.
This conversation seems very similar to the conversation we had on the UHT.
It is, and I do think it's a colossal waste of time, for generally speaking, for Revenue Canada. And it's also affecting not just Bear Trust, but also what I'm going to call normal family discretionary trusts. And to me, it's also a waste, because with a family trust, we're supposed to file a copy of the trust agreement, which outlines who the settlor, the trustees, the beneficiaries are in the first year of filing. So Revenue Canada has copies of everything. They're just choosing not to go and look at them. They want it on the form to be able to more quickly and electronically, presumably, do their checks. So it's not that the information was hidden. And if my family trust, I've got a cocaine factory, or I've got slavery, or pick all the vices we shouldn't be doing, I probably wasn't going to disclose it in the first place, my personal opinion. So I'm not sure that they're really getting a lot that's going to be a shock to them, because it's going to be the people, for the most part, that are trying to abide by the rules. And unfortunately, some of us are going to get hit up. I'm quite concerned about.
Yeah. Okay. So penalties can be big. I'm going to give you a scenario, George, and this is a property that we actually did this a few times back in 08, 09, somewhere in there, where we had properties in a corporation that are owned by a corporation, but we went to go refinance them, pull out some equity, etc. We did that, but we couldn't qualify through the corporation. So we qualified personally for them. So those properties are now in our personal name, but technically they're owned by the company name. And we got a trust agreement made up saying that they're owned by the company. That is what you would consider a Bear Trust, right?
That is one
I've never heard
correct.
the word Bear Trust before. I've just heard trust agreement, but it's the same thing?
It's identical.
Okay.
And part of the reason you probably never really heard about it, or we haven't talked about it, is this the first year we've ever had to do this. Beforehand, it didn't make any difference. It was just kind of dotting our I's, crossing the T's type of thing. But unless we were being audited, it really didn't make any difference. now, unfortunately, it does. And it's not that anything is done wrong, and it's not that you're going to pay any taxes. It's that now we got to go through the process, and what we're finding. I've got a load of trust to review, but the challenge for us is that first year. Once we've done it the first year, quite honestly, it's going to be more straightforward in terms of, oh, we've already listed all of the parties involved. What we'll have to watch is often in a lot of the trusts I've set up, for example, I will have it such that a beneficiary of the trust could be another corporation owned by the other beneficiaries as individuals. And so we just have to make sure we're updating for that and updating for, oh, there was a child born or a grandchild. And so we need to catch those. I think if we miss one of those, I don't think Revenue Canada is going to go after us. If, again, to me, that's an inadvertent mistake. What Revenue Canada believes is a completely separate matter, though.
Yeah.
But I think if we make the effort of getting those trusts in and try to do what's right, I expect, I don't know for a fact, that most of the auditors are reasonable people.
Yeah.
You're going to find a couple bad apples like you will with any other group of folks. But it's the getting that in, and now the challenge, quite honest, just from a timing perspective, there's been, maybe I've been more sensitive to it just based on my industry, but seeing articles in the media from various sources of media saying how challenging it is to find an accountant right now. And it's not that accountants don't want to help, it's that they're overwhelmed with what they've got, because it's not like we didn't have other stuff going on normally at this time of the year. And now to think about all the like for Peter and I'm pretty confident there's like 1,000 trusts, bare trusts that exist out there that we have to take care of.
Yeah.
And that's a lot of people power. And we made guesses, quite honestly, in terms of what the cost was going to be for people. We're trying to do all this planning back in November. Parts of it were planned beforehand, but in terms of the letters and the videos and whatnot that we did, and now we're kind of saying, well, we blew some of that because it's taken us longer to do it. Again, I think next year it'll be more accurate, and we just kind of, I think we were logical in the sense that we took what the cost was to do what we call, again, a family trust, and figured, oh, the bear trust is going to be easier, and it is. We just didn't factor into the same degree the conversations and the email exchanges that were going to be needed to isolate and explain things to clients. So on a go forward basis, we'll have that information there. It's going to be easier. But anyway,
Yeah.
I mentioned that in the sense of, I doubt if we're unique amongst accounting firms in the country. I think they're all experiencing the same thing, or at least those that are working with real estate investors.
Have you gone through the process of actually filing? And is it relatively easy for someone to figure out on their own?
I don't know how easy it is for somebody to do on their own. I would tell you it's not rocket science.
Yeah.
I think more people probably struggle with whether or not a bear trust exists based on the conversations I've had. I honestly don't know how easy Revenue Canada is making it to file the trust. So obviously BDO's got super duper software. And there's other types of software. So as dumb as this is, and it really, really, really irritates me, I can't use BDO software for my own returns and whatnot, because apparently I've got too many entities and they won't give me disk space, or it's not called disk space, but whatever they call it now. Anyway, that's a separate pet peeve. So I had to go out, and Robin and I had to get software to do our own stuff. And again, it's professional grade in that a lot of the smaller, medium-sized firms could be using this software. But I do not know what someone does for, they've got 2 or 3 themselves. They don't want to go and spend, I think Robin and I, for our own software, it's about $5,000 or so between personal, corporate, trusts, etc. And so, well, that's overkill. Can we just do a paper copy? Can we fill out a PDF form or something? And I expect that exists. I haven't specifically investigated it,
Okay.
But I like also the idea of the software, and that I can roll it forward each year, and now the advisors know what's going on. So it's I'm sure there must be a way of doing it for that normal person, if you will, to go and file, just as they're
Because
for
I
personal
know with
tax
the
returns,
UH,
it's so easy to do. If you for
yeah,
85% or so of Canadians, they don't need an accountant to do their tax return. They can do it themselves,
right.
or go to an H&R Block or kind of a discount shop. Um, an H&R Block is, well, I don't know what the real fees are. I just saw what their starting fees are, and based on prior experiences, I know that can escalate fast. But
Yeah.
unfortunately, I don't know what all those alternatives are.
Okay. So, yeah, I mean, with the UHT filing, it was fairly simple to do it. I did our properties and it probably took me, the first one took half an hour. The second one was, by the end of it all, I was getting them done in a few minutes kind of thing. They didn't take too long. But the Bear Trusts, if I have, I don't know, a dozen properties that have trust agreement on them, I'm just curious, how do I go about getting this done? Because I don't want to be paying the 5% fee or whatever penalty. So do I then contact my accountant and say, hey guys, we need to investigate this? Or is this something that I can investigate on my own? I guess that's my main question right now.
Well, I think people can investigate their own. And again, we're obviously at this point in time getting really, really close to the deadline. So your
Yeah.
accountant may not be able to do it at this point
Yeah.
in time.
Yeah.
And again, if it took you a half an hour to do that first UHT return, you were much faster than 99% of people, I can assure you, because
Okay.
most people did not know which boxes to tick, and they were going through. And
Mm,
again, once you've done the first one or two, like you
yeah.
said, the rest of them are probably 5 minutes type of thing.
Yeah.
But the first one or two were killers, particularly with some of the choices, and not.
Hmm.
Revenue Canada was far from clear on how some of those boxes were to be completed. Um, the trust ones, I think, are far simpler. I shouldn't say that. I think they're far simpler than the UHT returns,
Okay. Okay.
in that they are looking after, uh, again, who are the beneficiaries, settler, trustees, uh, the fact that you're going to put their name and address and social insurance numbers or business numbers, etc. That's not rocket science in my mind. It's just tracking that down. And so with Bear Trust, I think it's much easier than a family trust. So the family trust, as I said, we're going to have different kids, grandkids, corporations. Well, the Bear Trust, it's what exists right then and there.
Mhm.
It's really isolated to what's going on. So from that perspective, I think it's straightforward.
Okay. Good. So yeah, guys, going forward, let's just reiterate this. The deadline is what, in like 3 weeks here, roughly, less than 3 weeks. We need to file. Is there a tax involved in this, George, or is it just we just need to file so that they have our information? Or if we file something, does it then mean that we're going to get a tax bill because we filed?
The intention, or the theoretical intention, is that there are no taxes related to this. It's simply disclosure.
Okay.
Where potentially taxes could arise is if Revenue Canada, as a result of receiving this information, learns that somebody's been doing their taxes wrong for a number of years.
Mm,
Now
right.
there's issues.
Yeah.
But assuming that the taxes were being done correctly and it's been disclosed correctly, there should be zero taxes owing as a result.
Right. Gotcha. Perfect. Okay, let's put the Bear Trust thing to the side for a minute because we got a few other questions here that I think we should hit before our hour is up here. And I think we got that clear, guys. So just for everybody, if you're just joining us now, when it comes to this, what do we call it? A Bear Trust filing? Is that kind of what
It's a trust filing, of which Bear Trusts are one type of trust.
Okay, a trust filing, and this is due March 31st. There could be large penalties if we do not file. So guys, you need to look into whether you are required to file or not. And is there a place that somebody can go, or is there a resource someone can go to figure out whether this is something they should be doing or not, George? Like Do you have a PDF that we could send out to everybody, or is there a place they can go, a website or something?
Certainly, they can start with my website, the georgedube.com site. We've
Okay.
got a couple videos there.
Okay.
Revenue Canada actually has a really good website section onto this, and while I don't know the exact link, I'm sure you can Google something to the effect of trust disclosure Revenue Canada, and I imagine it'll pop right up there.
Okay.
And so their information, similar to the UHT, I think was probably as good as you could expect it to be, and I think they tried and did a really good job with it, quite frankly.
Okay. Awesome. Okay, let me see what other questions we have here. Okay, so we have a question from, let me go back here. I'm not sure who it was. I think it's Sean McGregor. So Sean was asking, he said that T3 filing is required for fiscal year December 31st, 2023 or later. If corporate fiscal year is earlier in 2023, does a T3 still need to be filed for 2023? Or is it effective next year going forward? Does that make sense to you?
To me, it does.
Okay.
So the T3 filing, which is the trust return,
Okay.
not to be confused with the T3 slip, which you could receive if, for example, you have a family trust or you even had your mutual fund. It could be there. But anyway, so the T3 returns are done on a calendar year basis, regardless of what the physical year ends of the company are. And so with the Bear Trust, assuming that's where this originated, again, there's really not going to be numbers on the tax return. It's disclosure of individuals or entities. So the numbers part goes to the corporate tax return itself. Or if you're talking a family trust, then the dividends paid from an operating company or a holding company to the family trust is concerned with not the operations of the corporation, but when the family trust earned those revenues during the calendar year, if any. So yes,
Okay.
calendar year trust, fiscal years for corporations.
Great.
A bit
There you
confusing.
go, Sean. I hope that answers your question. George asked a question. Are there any updates for the UHT for 2024?
Probably. I haven't really been paying close attention the last little bit, admittedly. So the last I saw, the legislation hadn't passed yet in terms of giving us relief from the filing measures that existed in the first year. But Revenue Canada has certainly been unequivocal in the sense of the legislation will pass and they're filing based on the proposed legislation, which is typical for Revenue Canada to do. So I don't see anything unusual there.
Okay. Jay asks, do you recommend having separate corporations for each joint venture?
It depends on the size of the joint ventures and the parties involved in different scenarios. For example, as a general comment, I think that having a separate company for each acquisition is probably overkill. Now, if we're buying $2 million properties and up, sure, that I can justify that cost then all of a sudden. At times, what I try to do where I've got some joint ventures or work is say, okay, am I going to have a couple $1 million of property in my mind with the same investor over kind of a 3 to a 5 year time period? And if so, why don't we just kind of a corporation for that particular person we're working with? Whereas if I think that this person's going to buy a $300,000 property with me and that's their capacity, and then I'm going to have Billy Bob and Betty Sue, et cetera, do similar things. Well, maybe what I'm going to do is have a corporation which has, assuming I'm doing a 50-50 split, my half of the properties in my company, and they can own their half however they want to own theirs. So you're trying to be somewhat practical, balancing legal and tax concerns. But again, to me, having separate corporations for each property, particularly if they're smaller, it's from a tax perspective, there's no advantage. I can appreciate the lawyer maybe saying, yes, there's an advantage to it. And now you're weighing what that advantage is and versus the cost associated with that.
Yeah. I think that's a great way to answer it. Depends on how many you're going to have within that corporation. We did the same thing. We had a corporation set up with a joint venture partner. We ended up buying 20 plus properties with that one joint venture partner. And then the ones that we bought 1, 2, 3, 4, 5 with, we just joint ventured with a different corporation. And we did a joint venture with each of those different joint venture partners. So depending on what our goals are. And that's where sitting down with George and saying, hey, George, here's my plans and here's what we're planning to do. What do you think I should do? You can start giving us some recommendations, right?
That's right. And believe it or not, I mean, you can tell even from that advice, I mean, we're not trying to set up a huge structure for no reason. We want to be able to, again, going back to comments earlier, I want to be able to show people, here's the value I added. And if I've got this huge cost of running 4 gazillion corporations that really didn't provide any extra tax value, it makes it harder for me. You got less money to really do important things, and you're probably not referring me as much as I would like.
Yeah. Yeah, absolutely. Okay. So here's a question from Andrew. He says, I may have missed this earlier, but I have 3 personal properties and want to incorporate. Would these properties be considered sold to the incorporation and subject to capital gains at time of transfer?
So making a couple of assumptions which are applicable in the vast majority of cases, so they're not unreasonable in my mind. Yes, they're transferred as compared to sold. I'd like to use the term transferred. And yes, capital gains are applicable. However, there is a tax election that's generally speaking available, not always, but generally, and it's pretty easy for us to determine if it's applicable, which will, when we file that tax election, it basically says to Revenue Canada, hey, here I am. I've just done this transaction, which normally tax applies to. I pleasantly decline to pay at this time because my net worth has not increased. I'm just indirectly owning it. And so please keep me on your Christmas card list, but let's talk next year. And so, again, not being a smart aleck for a minute, provided it's been done properly, and this is something we regularly do, we can do the transfer without incurring the income tax at the time. It's deferred until somebody, basically, there's a couple different scenarios, but the most common one is either somebody's passed away or we've sold assets, essentially. So we're not going to prematurely trigger that tax. Although sometimes, believe it or not, we want to, but separate story. It does not allow us to escape land transfer tax if that's applicable in the particular province or territory. And there's costs, of course, for getting the accountant to take care of the tax elections, working with the lawyer to do the legal agreements, because there's a separate, beyond the purchase and sale agreement, there's clauses that the lawyer needs to put in there to keep Revenue Canada happy as well. And Revenue Canada, on this tax disclosure form, one of their first questions is, did you really do the legal agreement properly? And did you include the clauses we're looking for? So you either are going to tick off that, yes, you did, or you're ticking, no, you didn't. Please audit me. This is like a freebie audit for you, and you're going to be prime minister the next day because this is easy pickings. So, I mean, it's kind of self-serving, self-selective, if you will. Or the person's going to lie on the tax form, and then they got bigger problems.
Okay. Let me see. Okay, we have a question from Alan. Alan says, for a real estate joint venture where only the money partner is on title, is the beneficiary the working partner? In this situation, does a Schedule 15 need to be filed?
So yes, the Schedule 15, which is reference to the trust return, needs to be filed. To save yourself some money, it's not just, you have 2 beneficiaries. It's not just, so in other words, it's both the legal land, sorry, it's both of the beneficial owners. So assuming that 50-50 split, So it's also the money partner has to be listed as one of those beneficiaries. If you just put the working person, or you just put the money person,
Mhm.
you missed half of it and you screwed up the form.
Right. That's kind of the point of this whole thing, is to put all the beneficiaries on it, right?
Correct.
Yeah. Okay. Okay. So does that mean then that the working partner, or let's say there's a working and a money partner in this scenario, both of them have to file on that same property, or does just one of them have to file with both names on it? Do you
One of
know?
them files with both names.
Okay. Okay.
Yeah.
So
So
one can do it.
it's sorry, I might get this wrong now. Um, I believe it should be the trustees that are filing on behalf of the beneficiaries. So normally it's the person that's orchestrating the whole thing that's going to take care of it, of course, but
Okay.
it doesn't mean it has to be that way. Just the key part to that is making sure the return gets filed and you're naming all the relevant parties.
Okay. We have some bigger questions on here that I don't think we have time for. So here's a question from, I'm not sure who asked it, but what's the friendliest and most effective method to transfer 33 properties from my personal name to an incorporation? If that's a long question, we don't have to tackle it, but if you have an easy answer for that, we can tackle it.
It's really, as odd as this is going to sound, it's really no different than transferring one property. It's just it's a volume, right, in decimal points.
Mhm.
The practical issue tends to be more so lining up times where financial institutions, if there's mortgages on the properties, are going to be accepting. So often where we've got clients with quite a number of properties of that nature, we're probably setting up a 5-year schedule of when we're going to be doing these transfers. And so it may not be a transfer, but a series of transfers, often just dependent again on the um, when mortgages are up for renewal, or the client has said, hey, I don't really care to let the bank know. I just want to do this. I'm going to use Bear Trust, which we've just been talking about, to help facilitate this.
Mhm.
And I'm willing to accept those risks. So generally, most people, particularly if they got a portfolio of that nature, they want to do things properly, get it taken care of. It's just sitting down and starting to plan that through, and to acknowledge too, again, depending on which province or territory we're talking about, that could be a land transfer tax bonanza, and that might have to involve a little bit of planning as well.
Yeah.
But it's conceptually it's straightforward. It's just because of the volume, it's more complex, I guess, if you will.
Right. Perfect. George, an hour has gone by. We have grilled your brain about many different accounting questions, about this whole Bear Trust and the filing that is due at the end of the month. So I hope for those that are listening, you've learned something new, or maybe you've picked up a point or two about something that you maybe need to pay a little bit of attention to before this month is over. And so Jules shared your website, georgedube.com,
Thank you.
in the chat. So for those of you that have more questions about this, feel free to go there, check out some of the videos that George has on his website. And we're going to have to end it there, George, because our
Very good.
time is up. So thank you so much for coming
Thank
in.
you.
We really appreciate this, and lots of good questions by many of our viewers today. And you kept a captive audience. We had over 50 live viewers all night long. So that's great, George. Thank you for that. And we'll see you soon over into our Zoom session, our laser session with our Ignited members. So we get you're gonna get grilled some more, George.
I'm sure.
I hope
I'm looking
you're okay
forward
with
to it.
that. Okay. All right. Thanks for joining us. Really appreciate it.
Thank you. Bye now, everybody.
All right, guys, there you go. Another great Tactical Tuesday. Hopefully you picked up a thing or two here and there that that does apply to you. If you have maybe somebody on title, but there's other beneficiary owners that are not on title. So if you have a JV agreement, et cetera, these are situations where this filing needs to occur by the end of the month. So just keep that in mind, and do what you need to do to get it done. Okay. For our Ignited members, we're going to see you over in laser session here in just a minute. And for everybody else, thanks for joining us. And guys, we have an exciting announcement. for the 41 of you that are still live with us right now. And that is, we have dates for our next boot camp. So if you missed our last one, you had a little FOMO for all of the people that were having a great weekend. May 10th to 13th, we will be holding our next boot camp. That's a Friday night, an all-day Saturday, and a Monday evening as well. And it's going to be awesome. So we hope to see you there. Jules will share a link to our early bird. So it's 50% off if you join soon in our early bird. And we'd love to see as many of you there as possible. It's a great event and a great weekend. All right, guys, thanks for joining us. And we are going to see our Ignite members over in our laser session. We'll see the rest of you next week. Take care.